your equities are probably going to be fine, but pay attention to your bonds. Be thoughtful about how you're allocating within fixed income. Are you being compensated to take credit risk at this stage of the cycle? Yes and no, depending on what you're looking at. Are you being compensated, though, to be in high quality credit if you can be in agency or securitized with really no credit risk and similar yield profile? So that's kind of what keeps me up at night. So I'd say bullish on equities, neutral to bearish on bonds.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Okay, welcome to this week's episode of The Bull of Wall Street. And this is going to be a fun one because it's just our own, the Wealth Consulting Group Investment Strategy Committee members and leaders. We've got on our CIO, Jim Warden, who's in Boston. You can see he's got the Red Sox hat on. Who are they playing tonight, Jim?
Tampa Bay.
All righty. We've got Paisley Nardini. I think she's at home in Orange County. Is that right?
Hanging out at home today.
And we got Callie Leger. He's in his home in Jersey, probably looking at the water. So anyway, it's been a nice comeback, right, you guys, from the lows that we had in April. And as we were just talking about a minute ago, I think we were very fortunate that we called this one correctly in the sense of risk on when it looked pretty ugly. And I think when it looked pretty ugly, it reminded me of like 22, 23, when the majority of Wall Street, very prominent economists were absolutely in the recession camp. And it sort of felt like we were getting there again. The same talking heads were on TV a lot during that time period. Talking about that we're headed to recession for sure this year. We all know who they are. We work with some of those firms. We like them. But as we talked about on some of the previous podcasts that we've had before, why could they be wrong again? So that's a topic I think a lot of financial advisors would want to know about, especially our advisors. And so I'd like to talk about that, what you guys think about recession. Most of you know Paisley is a portfolio manager, managing director at Simplify. So, while I don't think they have like a firm view, she and her colleagues over there, extremely smart individuals, very accomplished people, have their own views. And she's, as a spokesperson for the firm, I think has a good idea about, different people's opinions over there.
Yeah.
So anyways, I think I can talk about different things, but why don't we start with that? And since our macro person really, Tally, from a macro perspective, Tally, there's two things I want to start with asking you about. One is the chances of recession. Are we going to get one or not? And if so, when? And if we do get one, what kind of recession? But if not, then great. But also, you've got a very interesting view on tariffs. Everybody out there thinks that tariffs are inflationary. And you give prior example of tariffs. And so I don't know which one you want to start with. You want to start with the recession part? What do you think? Are we going to have a recession?
Well, so one of the first things that I did when I joined you guys is build a coincident recession diffusion index, which is one of our proprietary tools in the kit. And I'll cut to the chase. We're just not seeing it in the hard data. And that's, to your point, Jimmy, that's one of the big debates right now amongst the angry economists, we like to call them. They're still our friends. We're still friends, and we're kidders. We like to kid with them. But I think one of the indicators or concepts they were pointing to was this notion of a kind of emerging market like sudden stop in shipping and trucking activity. And I looked at this with Jim because, and I admit I was a little concerned, right? You want to be aware of your hidden blind spots and biases. So why not just take a look? And I think that's the benefit of the ISC's structure. And this is a little window into that kind of diverse thought or diversity of thought. So we looked at trucking and shipping activity. And my argument was that it looked like we saw a recessionary-like decline in that trucking activity index. And I'm thinking particularly of corrugated box shipments, right? So we were doing a little triangulation because the stocks were up here. I'm talking about the transports within the industrial sector, surging, doing very well. We didn't change our view, knock on wood there. That served us well. One of the great calls that we made as a team. But it looked like the box shipments really had their worst experience in the 02-03 period and kind of stabilized around the zero line. So to us, and I kind of conferred with Jim on this one. It really felt like the worst was behind us, and if anything, the stocks were starting to look across that valley of death to better times ahead. I don't want to make it too biblical because we want to keep it PG here and family oriented, but I think that's kind of the longer version of the short story I led with. Do you want to go to tariffs now?
Yeah, why do you think that tariffs may not be inflationary, which is, I think, again, the consensus view is that, we're going to get inflation, and that's why the Fed's waiting around to cut because of tariffs. So what's your contrarian view on that?
Well, to me, and remember, if you think about the concept of a tariff, it is essentially a tax hike. So that's why you can't overdo it with the tariffs. You got to go easy because it's a hit to growth and demand. When you tax something more, like incomes or profits, you have less of it, right? And I think the White House is very aware of that kind of tail risk or scenario of a potential global depression. You do not want to bring back the fears of a global depression. And I think that was the lesson from history that you were calling on me for, Jimmy. So whether it was Trump 1.0 or the Smoot-Hawley Tariff Act of 1930, we had disinflation, if not deflation, right? And so lo and behold, it's really no surprise to us in the ISC, and we've been hitting hard on that theme with that non-consensus view that, and I penned a piece about this in early February. I don't think the tariffs are as inflationary as everyone thinks. And if you think about it, really, you would have to have every month steadily increasing tariff rates in order to get the aggregate rate of inflation to keep moving up. And that's the point. If you think about it really simply, you put on your quant cap instead of your Boston Red Sox cap for a second, right? This is the wonks. We like to indulge a little bit, so I apologize. When you raise a price level, it's a one-off hit or increase in the price level of some goods for certain countries.
So maybe just to follow up on that as well, as thinking around the theme that for those that have talked about tariffs actually being, are they inflationary? Are they neutral? Are they deflationary? I think a lot of the discussion around deflationary potential is just driven by that demand kind of shock. Is that kind of your base case or thesis as well, as the market just can't bear at this point?
Well, yeah. I mean, so it's a great question. It's well placed, and that is the question for the historians. Why were the 1930 tariffs, the global tariff war at that time, ultimately deflationary? It's because everyone's trade went down together, and it exacerbated the effects of the global depression. It didn't cause it, but it certainly made it worse, more acute. So I think that's exactly what we're trying to avoid. We're escalating to de-escalate and hammer out some better deals.
Do you have thoughts too? I'm just thinking about like the rebound in the equity market that we've seen, kind of this like V-shaped recovery again. I mean, if you look at year-to-date performance, it seems like a non-event, right? And I think a takeaway I have, which is what many of us were talking about in the depths of the sell-off, was like, is this another buy the dip moment? And a lot of the, figureheads, talking heads came out. The doom and gloom, the fear driving was, this is, we can't rely on this buy the dip mentality anymore. And that's when people get rocked. But it proved out to be another buy the dip type of environment. So maybe it's a very long-winded way of saying, like, do you think the equity markets now have priced in what we believe is going to come forth with tariffs when the pause is up and maybe like the next 3 to 4 weeks here? Or, which is kind of my thought, like there's a lot more bumps on the road ahead. What are your thoughts on that?
Well, so I think Jimmy said it best, and Jim did it right. You could have gone on a 2.5 month long vacation and come back.
Would have loved that regardless of the markets, but go ahead.
Right? Yeah. Well, you would have saved yourself from the emotional cost of a round trip ticket and risk assets, right? And it was like nothing happened. So, I love that, again,
Allie.
Yeah.
I love that one.
You love that one.
Yeah.
I'm kind of boring from my own literature, but yeah, I mean, so Jim, I think you had the right idea. Just calm down, everybody, and our advisors really did a great job putting the plan in place, doing the hand holding, because we armed them with really good content and insights to keep them buckled in and avoid those self-inflicted wounds. But it's a great question, Paisley. So another tool that I developed for us to help inform the kind of risk on, risk off stance across the portfolios is our sentiment and positioning indicator, SPY for short. Now I think that risk tolerance, just to put it in simple terms, did bottom right when we expected it to. And that was in, I guess it was the second or third week of April, whatever it was. That has turned, but we still see a lot of more room for the bulls to run. And I don't see us waving the checkered flag on the rally until that SPY indicator swings to the opposite end of the sentiment spectrum. And that would be above +1 standard deviations away from the long-term average. And we're just not there yet. So I think, just to land the plane on the answer, sorry, this was a long one, but from a seasonal perspective, and Jim's a technician, so he'll appreciate this one. We usually see the turbulence once again in September. And so, I mean, look, if you're bored and you're looking for opportunities to buy on the weakness, I think that's when it could resurface. Until then, just enjoy the rally.
Okay, so interesting. I'm just thinking about like summer months, like the tariff pause comes up, there's less liquidity given like just market seasonality, et cetera. The fiscal package discussions, deregulation. It just seems like there's a lot that could come forth in the next like 2 months before the summer's up. So you're saying like it might be smooth sailing through the summer, but back
June, July, August are typically great months for equities. Yeah.
And I'm wondering, Jim, if you want to chime in on recession or not, and then, but technically, since you are a CMT as well,
yeah,
it seems as if we're setting up like I think it's a great point, Paisley, that she brought up a lot of like things that might be happening like right now that might be newsworthy that could rock the markets. But from a technical standpoint, from what I'm hearing, it seems like we're setting new highs, and new highs beget new highs. Where are we at technically, and what do you think about recession chances?
So I think the recession chances are still there. It's lower certainly than it was when we had, what was it, Liberation Day, and we had the little chart saying 130% tariffs, and that was kind of wild, right? I mean, it was like. And I feel like the markets did really get scared, but it was one of those things that it was the big difference between the hard data and the soft data. The soft data was like the world is ending. Fundamentals were still good. And, if you look at the technicals, I put out a chart with a weekly market update yesterday, and that shows that we're still in a good place. Even with that drawdown, we're still like finding support, moving a lot higher. We'll probably get some resistance at the highs once we get right around the highs, and we're not that far from there. I don't know if it's going to be 100% smooth sailing, from now until September. We're still going to have, a little bit of volatility. There's, earnings have been great, but we still got Trump talking and Musk. And so you have that, but you also have this, I don't know, as some people mentioned, I dare I say taco, but there's the taco.
Wait, what's this?
Part of it. You haven't heard taco?
No, I've been living under a rock. Fill me in.
So taco stands for Trump always chickens out.
I have not heard that.
So, well, and I think really what it is, and we've been saying this all along, right, is that he's not trying to put some permanent tariffs out there. He's trying to renegotiate things. He's trying to reset things and level the playing field, which is what kind of our original hypothesis was, that he's not trying to screw the rest of the world and it's all about America. It kind of sounds a little bit like that, but it's, hey, let's renegotiate things. So technically I'm still very bullish. I talked to Bloomberg Radio last night and I think what's happening with earnings and particularly with technology is, it's this fast moving train and you might be able to slow it down a little bit with some tariff talk and some macro concerns, but it's going to keep going. It's going to keep going. Quality is still good. A lot of these companies, the cash flows are getting better, right? So what more could you want? You get a good trend, you get momentum, you get the earnings and cash flow behind that. So I think we keep going, but and it's interesting too, because usually, the technical people say it's go away in May, right? But you did not want to go away in May. May was a very good month.
So interesting too. I'm just thinking about a lot of the subsequent rally that we saw. There was this continued discussion that it was led by retail and that institutional investors, primarily been on the sidelines, and just thinking about some of these bigger institutional plans that more at a quarterly kind of rebalance cadence, coming up at the end of this quarter. It'll be interesting just to see if there is continued flows. Ultimately, what I'm trying to get at is just for the fact that institutional asset owners have not necessarily gotten in on the upswing. That could be a catalyst for continued upside in the markets if all of a sudden you have some big flows, just given the fact that for the most part, markets appear to be kind of smoothed out. So you could see that tailwind from institutional asset owners coming through in the next couple months as well.
100%. And this is what makes me a little bit more bullish, is that there's still some bears out there. There's still some bears. It's a very hated rally because a lot of these people didn't participate. Right. So to the degree that they're going to get back in and they missed it, I mean, it's great for us because we were well positioned. We actually added to some of the names that were really beaten up a lot, and they've just a lot of those are right back to where the all-time highs were or higher. They're at new all-time highs.
Hey, can I actually dig in? Because I wanted to ask Paisley a question, because it'd be a neat thing to kind of unpack. So when you look at the American Association of Individual Investors, and that's one way to kind of get our arms around this issue. And Jim just said it. We've actually got more bears now in that survey. So there's a dichotomy between, and this is what I'm getting at, what they're saying and maybe perhaps what they're actually doing with their money. So I've always wondered, Paisley, maybe Jim, anyone on the call here, what have you guys seen, or can you think of a way to actually support the notion that it has been retail investors spurring stocks higher here? Is it flows? How do you break that out?
What I've read is it's flow driven. So it's a lot of ETF flows. It's a lot of retail flows. I think the feedback, whether it's actual data that's providing this or more sentiment, is just that institutional investors did not participate. How that is precisely quantified, I don't know for certain. But I've heard it in numerous sources.
Yeah, so have I.
Yeah.
I think they look at things like, like Robinhood's earnings and
Yes.
revenues too and stuff like that. And I was going to say, now that Paisley is managing a debt fund, a bond fund, right? We got to get you away from the fixed income people, Paisley, because they're the ones that are depressing. They're going to figure out ways for the world to end.
Well, that's what I'm thinking about as we're chatting here. Is we've talked a lot about like equity markets, which are the predominant driver of risk and return in any balanced portfolio. I guess what like my thoughts broadly is more thinking about most clients have a multi-asset portfolio. I'm not concerned about equities. Fundamentals are strong, technicals are strong as well. I don't see a clear catalyst for a recession within, being priced into equity markets. But what does keep me up at night and where I do think there is a little bit more, maybe more bearish sentiment is in the bond part of the portfolio for obvious reasons. Like I'm not going to say anything everybody's not already aware of, but the continued volatility in interest rates. I mean, we saw a historic price action in the MOVE index. The MOVE index is the measure of volatility of bonds, whereas the VIX is volatility of equities. And we saw that occur obviously in April. It really shook bond markets. And I think fixed income bond allocations have continued to be a thorn in the side of a balanced portfolio. And so I'm less bullish on bonds unless we had a full-blown recessionary growth shock, which I don't see the reasons I just mentioned within like the fundamentals of equity markets. And so how do you think then about diversifying away from that? And that's where I spend most of my time, just given the nature of the strategies that I manage and the clients that we speak to. But it's really like your equities are probably going to be fine, but pay attention to your bonds. Be thoughtful about how you're allocating within fixed income. Are you being compensated to take credit risk at this stage of the cycle? Yes and no, depending on what you're looking at. Are you being compensated, though, to be in high quality credit if you can be in agency or securitized with really no credit risk and similar yield profile? So that's kind of what keeps me up at night. So I'd say bullish on equities, neutral to bearish on bonds, pending any kind of imminent growth shock in the market. And ultimately, I think kind of going back to the comment on sticky inflation and thinking about the Fed's dual mandate. And I think until we start to see the employment data reflect weakness, I think they're going to be status quo. There's just whether or not inflation, jumps, 10 basis points each month or comes down. I think it's kind of in the range, it's trending lower. And unless we have some massive inflationary shock, which I don't foresee happening for reasons that Tally mentioned as well, I think we're going to be dependent on employment data. And again, we don't see any massive cracks. And until we do, I'm still pretty bullish on equity markets.
Well, Jim, when you at the beginning of the year, what was your call? He's one of the brave souls that actually picks a number for the SP 500. What was your call for the end of the year target?
Yeah, so beginning of the year it was 7,000, and I think in April when we all got together, I said there's still a path to get there. It's going to be harder, but we can still get there. And we talked also about 2 to 4 cuts in terms of rates. I'm still in that camp, but I'm with Paisley. I'm more concerned with bonds, and I think the moves that we made to reduce duration and to add to some of those areas like more securitized debt, high quality credit, and to be a little bit closer to the front of the yield curve certainly helped with the volatility.
That's an interesting comment, actually, that's something we've been talking about quite a bit lately, and not just at my firm, but just, the PIMCOs of the world and the other, like the double lines, the other bond managers, is there's just obviously a lack of a bid for long duration assets. And there's been numerous discussions on what's driving that lack of bid. We don't have time to get into that today. But at the end of the day, they just viewing kind of what they call like the belly of the curve, the intermediate part of that curve, like that 5 to 10 year being far more attractive. And so a lot of these like fixed income bond managers are coming in on the curve, finding value in the belly, which if the institutional asset managers are starting to pull, capital away from that long, and that'll be a further catalyst for kind of a backup or higher for longer So I just think that's interesting as well, just from a fixed income positioning perspective in portfolios. If the Fed's not going to cut in the foreseeable, front end might stay kind of anchored where it's at, and the long end kind of continues to steepen. How can you take advantage of that in your fixed income positioning?
So I want to come back to both you and Jim to talk about private credit. I've got some questions about that based on some of my conversations I've had with some of the providers out there. Before there, though, Tally, what do one of the things you've been saying lately too, which I like personally, is, and this was the viewpoint that you had earlier in the year, which was international markets is one. And then right now, timely, the asset area, or the part of the market that hasn't participated, obviously, is small cap domestic stocks. You were talking about mid cap stocks earlier today on our investment committee call. Tell us why you like mid cap US or smaller cap type names, as well as international still, even though that we've had a nice run internationally so far this year.
So I think we've kind of seen a nice glimpse of what could be more to come on the international trade. And it really starts with the weakness of the US dollar, which had been something like a 14-year barrier to that segment of the global equity markets. We've seen structural outperformance on the part of US equities, and the natural byproduct of that really long run has now been stretched valuations in an absolute and relative sense. So that, I guess that's point number two. The flip side of that statement is that international stocks now, after that long run of underperformance, are attractively undervalued. So there's so many opportunities to be kind of combing through and identifying. That said, I don't think that there's a real sense of urgency here. I think that this could be the leading edge of something that could be multi-year in duration and maybe even magnitude. And I get back to part of the dollar discussion is how overvalued it is on just a kind of traditional classic purchasing power parity model. We're as overvalued now as we were back in 1985. And I bring that up because that was the time of the Plaza Accord, where the kind of global trade counterparties met in the hotel here in New York to intervene in foreign exchange markets and weaken the U.S. currency to kind of correct some of these trade imbalances or deficits that were seen as being unsustainable. That should sound familiar, folks, because that is potentially exactly what is kind of coalescing right here as we speak. We're having these kind of trade deals and discussions, and Scott Bessent himself has said that if there is another Plaza Accord type of moment, he wants to be a part of it. So I think the currency is one part, valuations are another, and a third dimension to the discussion is kind of the unleashing of the fiscal firepower, if you will, in Europe, and that really gets to defense spending. And those stocks, I mean, it's getting out of control now tactically, but those stocks have been responding and really driving the outperformance from Europe in particular.
That's great. I think, Jim, from our viewpoint, from the investment models, we have, I think, enough of an allocation to those two areas, right? Lower, market cap type stocks and international stocks.
Yeah, we do. We've been adding, and even in our models where we own stocks, we've been adding some in there. They've just been bubbling up, right? So if you can get good quality momentum, and the value is also good, and these are diversifiers, fantastic. We'll take them.
Well, there's another dimension there. It was the small and mid cap stocks you asked me about. Sorry, there was a lot to kind of unpack in your question as usual, Jimmy. But I like the mid caps because they have this kind of embedded or natural buy low, sell high discipline. Because if you think about it, they kind of benefit from the rising stars from the small cap realm, they become mid caps. And if they succeed, they rise and sell them on up to the large cap space, wash, rinse, repeat, and until really rich. And so that's why I kind of structurally have a liking when it comes to the mid caps, and they actually have good earnings historically. Small caps, that has been a challenge, and I would admit the small cap trade has been frustrating and disappointing because they're not known for their profitability. In fact, they can give you misleading valuation signals because you've got structural losses in the denominator. That's the E in the PE that kind of explodes or expands the quotient. That's the PE and makes them look more overvalued. It's deceiving. So I wouldn't turn your nose at small caps, but they really need the bond yield side of the cap structure to calm down and ease some of that pressure on the asymmetrical debt burden that small companies have.
Well, you also, I think the tailwind for small caps is these usually don't do well when the dollar is kind of falling, right? So they do better domestically. They're not exporting. They're just and some of the trade tariff concerns about steel and some of the industrials, and I still love industrials. I think it's a great place to be, but like some of those and some of the smaller financial services companies kind of in that small to the mid cap range. But we've certainly benefited for those companies that are in tech, particularly in quantum or energy, that are smaller, mid-sized companies, like to your point, Tally, that are like really benefiting from what's happening.
So I think what I heard was for small cap to do well, we need to get through the tariff issues, and then probably interest rates need to start coming down, and that'll help out the financing costs for the small companies. So let me switch gears. I want to ask both you, Paisley, and Jim, about alts. I know you guys have been working on alts for us in our portfolios, but I was just at a meeting and a lot of smart people like you guys in the room, and they were talking about alts, and one gentleman said, one thing that scares me is when everybody's trying to get into the same product class, and asset management firms, the large ones, are creating new products daily, it seems like, to go into privates. Why? Probably because they're making less money on ETFs, is my guess.
That's exactly it.
They need to have higher margin products. So everybody's coming out with their, go to the retail investor like our clients to raise institutional style, historically money for these types of investments. That being said, I think there's a tremendous opportunity in a lot of alts, but I want to ask first about private credit. So I was talking to a firm, credible firm, good track record. I'm not going to mention the name. They're telling me that they're, and the loans that they make are not to the big cap companies, like some of the products that we've used in the past that I've used. They're more to the smaller end of the marketplace. And, they're telling me that they're giving clients a net 12% type return after their fees. And it just seems too high, meaning that a lot of things have to go right. If you're borrowing money at 13, 14%, right? Any business, especially smaller ones, in order to overcome that. Now, maybe if it's a short-term deal, because you're in some sort of a transaction on the equity side, maybe you guys comment on that? Because I feel like there's so many different flavors of private credit. Flavors and so many different vehicles out there now that I would really caution our advisors, buyer beware, in terms of it's not all the same, right? Just like with stocks or bonds. Go ahead.
Very high dispersion asset class for sure. And to your point, the due diligence, especially as you come down market from an investor perspective, you get into the retail investor, even some of the high net worth, they don't have due diligence teams. Hopefully they're working for a firm that's doing some of the due diligence for them, in which case you are getting access to institutional research management teams. But there's so many flavors out there. There's a lot of saturation in the marketplace. I mean, private credit less than 10 years ago wasn't even an asset class in a lot of institutional IPS statements. Like they had private equity or they had an alternative sleeve, but private credit really just started to come up the curve. And then to your point, given the investor interest and the ability of some of these larger asset managers to build these teams out or either acquire them and bring them in-house, it's a really attractive fee generation or revenue source for these firms. And then I think just the saturation of the market. Now everybody's like, oh, I guess we have to have private credit. I have concerns, and again, I'm maybe a bit biased. I work for a liquid alternative shop, but with that being said, I think there's a lot of ways, especially with the level of interest rates today, that you can grab, a double-digit type yield number without having to lock up capital. And I just think it's not a one size fits all. Again, not only from like a due diligence perspective to understand the risk that you're taking, because there's no such thing as free lunch. You don't get 12, 15% return and not have risk in that. And the ability of these clients to understand those risks, I think, is being overlooked. And I do think too, there's just been a lot of new products coming to market where I actually see it as a positive sign that investors are starting to question and starting to look at more liquid parts of the market. Just again, given the level of interest rates, the ability to get 9% liquid versus 11% illiquid, I think most people are willing to sacrifice that 2%. With that being said, there is a use case for private markets, for liquid assets. I just have concerns with it coming down market so quickly. And even with some of the new rules on interval funds, removing the accredited investor requirement. So now all of a sudden anybody can access an interval fund. And we've talked a lot about that on this committee, the operational burden, trading burden, and the understanding that if you put money in an interval fund, just because there is a quarterly ability to get out, it doesn't mean all your capital gets to come out. So I just think there's just needs to be continued education. And again, more back to the fundamentals of this space. To your point, Jimmy, with this type of stress in the market and from a refinancing perspective, these companies having to go into, the private markets versus like going directly to banks for these loans, after a while, 12, 13, 14% interest rate, like that's going to have ramifications on some of these companies. And so we've yet to see that flush out of the system, but I wouldn't be surprised in the next, 2 years if we start to see some, increasing level of defaults in that space, and what that means then impact on some of these funds' performance when, again, investors might be reaching for yield. And I would say this is not the type of environment that you want to be reaching for yield. Sacrifice maybe, 200 basis points if it means you can sleep at night and have daily liquidity.
Jim, go for it.
Yeah, so I would agree really with pretty much everything Paisley's saying here. I'm out here Boston at a conference, and so I'm talking and there's a lot, to your point, Jimmy, there's a lot of private credit shops that are out there. A lot of them are different, so there's some differentiation. But I feel like there's just so much money going in there, and we know some of them that have gotten very big. So I do get concerned with capacity when you have got a lot of money going in here. And, we haven't had a period where people want to get their money out. So similar what happened to some of the non-traded real estate, big firms. I'm not going to mention who they are, but who I'm talking about. Like we could have a situation like that. I'm also concerned with those that are going in, the deals are sponsored, which means that they're going in with private equity. There's a lot of money going in there. Even the private credit shops that are selling these strategies, they acknowledge that. They fully acknowledge there's a lot of money going in there. Sponsored deals, the docs and the due diligence and the origination doesn't look, because it's super competitive, it doesn't look as good. So I would just be very, very careful in some of the things that you go into. Make sure there's collateral backing it. And not to say that it's all bad. I think there is a place, but I would say it's probably your client that's got a couple $1 million. They already have a very good liquid portfolio of stocks and liquid fixed income, and then they want to go to private credit. Maybe they already own some private real estate. So maybe a little piece of that isn't going to hurt them, but they have to understand that this is, not something that is going to be fully liquid. And there's different types of structures, right? There's some drawdown structures. There's some evergreen structures. So a lot more goes into the due diligence for these things.
Yeah. And the 12% plus return that the one firm I was talking to, I think that's levered, but still,
Yeah.
I think it's a lot better to take a few 100 basis points less.
Yeah.
It's a lot safer from an advisor standpoint. It just seems like the yields, I've never seen the yields like this high before, really, I can remember in my lifetime for good debt. So on one hand, I think you have to be careful, right? On private credit. On the other hand, there's some really great opportunities to get some yield that's just not normal because we got the Fed funds rates pretty high.
Yep.
If I could switch gears and talk about something else, which is Mag 7, large cap tech. Okay. So obviously, if you've not been an index investor, you've not participated in some of those names, you're absolutely underperforming, S&P 500, large cap US growth index. But do you guys think the party's over? Meaning 22, those stocks got rocked. The FANG stocks, I remember from top to bottom, it was a pretty steep decline. Happened again, I think, this year to some degree. Maybe now is more selective to certain companies in April from the top in February. But what's your guys' opinion on that? The large cap tech growth trade, and there's a lot of banter and talk amongst CFAs and professionals like you guys around, they might should be in their own asset class, even though they trade at sometimes high valuations, but they have so much cash, they create so much cash. They don't depend on bank financing for a lot of their expansions. So maybe Tally, we start with you on that one.
Well, so I actually talked about this this morning on the monthly call. So if you look at that old NYSE FANG Plus index, that's Facebook, Apple, Netflix, Google, and some others, it actually broke out to a new high. And the S&P 500 is recovering, but it has not yet technically broken out to a new high. We think that's in tow, but this is important. And I think at the same time, the XLK, that's the Spider Select Sector Technology ETF, broke out to a 65-day fresh high. So that's been kind of helping the optimism here. But I mean, you might ask, well, what's driving that kind of rebound and recovery in the M7? We'll call them for short. How about good old fashioned earnings? So at the beginning of the first quarter reporting season, Mag 7 earnings growth was expected to be 16%. Now, by the way, all 7 companies have reported it came in at 27. So that is a really nice beat, a real solid beat. Okay. So that's, I think, supporting that kind of near term dynamic where the punishment really got overdone to the downside. And Jim and I just said, this isn't right. This doesn't feel right. And look, markets freak out, right? They deviate widely from the fundamentals and they still look pretty strong here. Having said that, that's the tactics. Strategically, looking further out, look, it's the law of large numbers. 30% earnings growth rates really aren't sustainable over longer periods of time. So I think it's reasonable to expect the fundamentals to settle into a more sustainable pace of growth, and this kind of really speaks to a broader, healthier underlying market where the Mag 7 kind of slows slowly or normalizes. I think that's probably a better way to say it. Whereas the 493, the rest of the market kind of picks up to a healthier, faster, modestly faster pace of earnings growth. And that I think could do a lot to help the smaller, large size companies and the mid and small caps.
So I would just add, if I could, so like if Dan Ives were here, he would say the party's still going, right? We're still gonna. What is he? I think he said he was going to end at like 4:00 in the morning. So maybe we're like 10 or 11. So it's still going. I still like the Mag 7 names. I like some of them better than others. I think some of them are a little bit more magnificent than others. But I still like all of them. But like having said that, when I put my risk management hat on, it's, we have tighter position sizes. We're not going to own as much as the market now we're very, very fortunate because we're outperforming in multiple ways, compared to the market, with smaller position sizes, but that's just diversification and some of the smaller names, that maybe aren't as big. I think there's more sensitivity for the names like Amazon and Tesla just because of what's happening with China. So that I think could get better, and those still have a ways to recover. Nvidia is getting closer, and so I think the AI theme is still playing out. I do agree with Talia that a lot of those 493 names, not all of them, but a fair amount of those, it's the second derivative, third derivative that they're going to start deploying AI more. They're going to start using it more. Productivity is going to increase. Research and development costs go down. They may not need to hire as many people. That's more of a long-term thing. But if they can control inventory, supply chains better, it's deflationary. And so I think that's certainly one of those forces that you have to look at and say, this is not inflationary. This is deflationary, if anything.
All right. I'm about ready to get kicked out of this room, this business center at the hotel I'm at. So I don't know if Casey wants to jump in on that, but I do have one last question, which is a good segue to my last question, which was about geopolitical risk. And to kind of summarize what you guys said, I think that, yes, we still like those big names, but we think that there was going to be broader participation possibly from other areas, right? So last question is, and maybe one or two of you can chime in on it, is just that geopolitical risk with China. The one thing I know that it seems as if the Democrats and Republicans agree upon is they want to decouple from China. And I think that all of us Americans were surprised to learn about how much dependency we had on China for everything, including medicine and pharmaceutical products and things like that, right, during COVID. So if you guys could just quickly chime in on that and how you think it may affect some of these names like an Apple or an Amazon. Go ahead.
Just a quick closing question. I do think actually we had Jason Su on the podcast, just kind of his thoughts on China from a fundamental valuation basis. China's continued to get rocked from an investment perspective, right? So there's two ways to think about it, like the economy broadly, supply chains, our relations with the country. And then there's also the investment lens, which I tend to more kind of gravitate towards just to stay in my lane. I'm cautious on China from an investment perspective. I think that, it's not to say it can't offer an attractive opportunity, but I think there's plenty of other things to choose from. And I do think if there's any administration that wants to see us decouple and wants to see China suffer, it's the current. And so I will take that at face value. I don't think it will be as bad as it is being discussed. Nothing ever is usually played out as bad as we think it might be, but there's plenty of risks there. There's plenty of choppiness, I think, ahead. So I'm neutral to bearish on China.
And maybe I'll close with just the conversation I was having with one of our previous guests. And we've had so many amazing guests, haven't we, on this Bull of Wall Street podcast?
Unreal. I was thinking about it the other day as well. Kudos to you guys. This has been awesome.
And you, it's been so amazing. But I was talking to JOC, Jim, John O'Connor.
Yeah.
He was commissioned by the Joint Chiefs of Staff. And actually one of Pacey's colleagues was at this meeting in Hawaii, and it was a war game exercise.
Wow.
For a potential China invasion.
Casual weekend activities.
So, it's pretty fascinating when you talk to people that are in the know on intelligence about what's underneath the surface and the headlines. Mm-hmm. I can tell you that he's pretty skeptical about China really opening up their economy to our companies the way that the Trump administration would like for them to do.
Yeah.
Lean into that I think that's probably more likely. So that being said, I think that let's conclude this, but our pros believe that there's upside in the markets on stocks. There could be some volatility, but maybe, who knows, maybe some news comes out recently or more recently in the next few months that could cause some volatility, but that's probably a good buying opportunity. Maybe seasonality, September, we could see another pullback. Jim's real bullish. There's a chance we can get to his number that I won't say because it's a high number from where he predicted at the beginning of the year. And then, but cautious on bonds and what happens there. And overall, I think we're pretty constructive about investors putting money to work and working with professionals. So thank you very much, you guys, and look forward to talking to you next week. Thank you.
Thank you.
Come and dance on our floor. Take a step